Welcome to Iron Financial. This is the place where we forge stronger portfolios because we are not afraid to stress test the market's weaknesses. And today, we are putting AON PLC directly under the microscope. We are going to tear down their latest earnings report piece by piece, bolt by bolt, because these numbers, well, they're telling two completely different stories. And look, on the surface, everything looks solid. But our job, our only job, is to find those hairline fractures before they turn into catastrophic failures for your portfolio. Let's get to work. Okay, so right out of the gate, the market rips open this report and sees one thing and one thing only, a solid earnings beat. The adjusted earnings per share came in at $4.85. That is a 1.82% surprise over what Wall Street was expecting. You know, for the bulls, that's the signal. Clear as day, it's a green light.
Hold on. You can't just look at one side of the ledger and call it a day. That's how you get burned. While everyone was cheering the earnings beat, they conveniently ignored the top line, the actual money coming in the door. Revenues landed at $4.3 billion, which is a 1.73% shortfall from what analysts were forecasting. You can't spend that. Less revenue is less revenue. So this brings us to the core question we have to answer today. Is ION a truly solid, steel-reinforced structure that's ready to build on? Or is this just a really nice paint job on a facade that's hiding some serious problems?
All right, let's fire up the forge. We're not just going to skim the surface here. We're going deep. So here's our blueprint for how we're going to break down AON today. First, we're going to build the bull case. I'm talking about the steel beams that are holding this company up. Then our skeptic here is going to bring the sledgehammer and really stress test that foundation. After that, we'll get into their blueprint for 2026, take a hard look at their dividend strategy, and then only then will we deliver the final Iron Financial verdict. Let's get to it. All right, I'm starting with the bull case, and I want to be crystal clear about this. I am completely ignoring the market noise for a minute. I don't care about the sentiment, the headlines, the daily chatter. I'm focused on one thing and one thing only, the hard numbers. The actual steel framework of the company itself. We're looking at the machine, not the weather outside. So let's dive into what AON is actually building internally, because honestly, it's pretty darn impressive. So this is it. This is the number that got all the headlines, $4.85 in adjusted earnings per share for the fourth quarter. This is the number that beat Wall Street. But look, a single number in isolation is totally meaningless. It doesn't tell you anything. We need context. We have to see where it came from, how it was forged, and what it really means for the structural integrity of the entire business. Now, this is what I'm talking about. This slide puts that number into perspective. See, it's not just a beat against some analyst's guess. It represents a clean, powerful 10% year-over-year increase from the $4.42 they posted in the exact same quarter last year. This is not some accounting trick. This is a clear sign of operational leverage and real profitability. It means that for every single dollar of revenue that comes in, they are getting better and more efficient at turning it into bottom-line profit for shareholders. That right there is solid fundamental growth. And this, well, this right here is the lifeblood of any company that's built to last. We're talking about full-year free cash flow. AON's core operations generated $3.2 billion in pure, cold, hard cash in 2025. And that's after they've paid for all the capital expenditures, everything they need to maintain and grow the business. This isn't some number on a spreadsheet, it's actual cash in the bank. And even better, it's up a massive 14% from the year before. This is the cash that fuels everything else. It pays down debt, it buys back stock, it funds the dividend, it lets them make strategic acquisitions. A business that gushes cash like this has options, and in this market, options mean strength. So what did they do with a huge chunk of that cash? They fortified the entire structure. They paid down $1.9 billion of debt just in 2025 alone. Now think about that for a second. In an economic environment where interest rates are a major concern and uncertainty is everywhere, AON is actively de-risking its own balance sheet. They're cutting their interest payments, they're increasing their financial flexibility, and they're proving to the market that they are incredibly disciplined with their capital. You know, this isn't a flashy move that gets headlines, but it is an incredibly powerful one. It's like ripping out old wooden beams and replacing them with solid steel. And when we zoom out and look at the full year, that foundation just looks even stronger. You can see the consistency right here. Total revenue up 9%. Adjusted EPS up 9%. That incredible free cash flow up 14%. But look, I want you to focus on that organic revenue growth line, plus 6%. The press release makes a huge deal about this, and they should. This is their second straight year hitting 6% organic revenue growth. That proves that last year wasn't a fluke. It shows this isn't a one-off performance that was driven by an acquisition or some weird currency fluctuation. No, this is a consistent, durable growth model at work, and it's firing on all cylinders. So, here's the crucial point. Management is basically shouting confidence from the rooftops. The CEO himself, Greg Case, is telling the market in no uncertain terms, we have a plan, the plan is working, and we are not just maintaining, we are accelerating into the new year. So when you combine that kind of confident outlook with a fortress balance sheet, powerful cash flow, and consistent, real organic growth, well, the bull case becomes very, very compelling. This is a well-built machine. Okay, that's a strong internal picture, I'll give you that. The engine room looks fantastic, but a ship doesn't sail in a calm harbor. It has to go out into a stormy sea. A company doesn't operate in a vacuum. You can build the strongest foundation in the entire world, but if you build it on top of a sinkhole, guess what? You're going to have some serious problems. So now let's apply some real external pressure. Let's stress test the structure and see if we can find any cracks in that armor. This right here. This is the question that every single investor looking at Avion has to be asking themselves right now. If the internals are this good, if the cash flow is this strong, if debt is going down and the CEO is practically doing a victory lap, then why in the world isn't the market rewarding it? The stock market is supposed to be a forward-looking machine. It's supposed to price in this kind of strength. The fact that it isn't, that is a huge warning sign that something else is deeply wrong. Let's look at the tape. And here it is. The proof is right in the pudding. Just look at this chart. AON is sinking while the rest of the market is sailing higher. We're talking about a nearly 5-point performance gap in a single month. This isn't just a little bit of underperformance. This is a vote of no confidence from the big money, from the institutions that actually move the needle. They are selling this stock. And you have to ask yourself, why? What do they see that maybe we don't? To me, this is a major crack in the facade. And as we dig deeper, we see that AON is operating in a really, really tough neighborhood. See, this isn't just an AON problem, it's an industry-wide problem. According to Zacks, the entire insurance brokerage industry currently sits in the bottom 19% of over 250 industries that they rank. And their research on this is crystal clear. The top half of Zacks ranked industries outperform the bottom half by a factor of more than 2 to 1. It's an old market maxim, A rising tide lifts all boats, but a falling tide grounds them. Right now, AON is trying to swim upstream against a very, very strong current, and that makes outperformance incredibly difficult. And finally, let's circle back to those adjusted numbers you were so proud of a minute ago. The company wants you to focus on their adjusted EPS of $4.85, but their official by-the-book GAAP earnings, that's generally accepted accounting principles, the actual rules, were a whopping $7.82 per share. Now, I know, adjustments are common. Companies like to exclude things they consider non-recurring. But when the gap is this large, it forces us to ask some very hard questions. What exactly are they excluding? The press release mentions things like amortization of intangible assets and restructuring costs. But are these items truly one-time if they seem to keep happening year after year? Is the adjusted number giving us a true picture of the company's core earning power, or is it just masking a bunch of underlying costs and complexities? It's a crack in the transparency, and that's something you have to watch out for. Okay, you've raised some very valid points about the external headwinds and the market's perception. And believe me, management isn't blind to this. They know the environment they're operating in. And in response to that, they've laid out a very clear blueprint for 2026. This is what they call their 3x3 plan. And it's their direct answer for how they plan to navigate these external pressures and, frankly, prove the skeptics wrong. Their guidance here is completely unambiguous. They're committing to continued mid-single-digit or greater organic revenue growth, building on that 6% consistency we just talked about. They are guiding for 70 to 80 basis points of adjusted operating margin expansion, which just means they plan to become even more efficient. And they are promising a continuation of strong adjusted EPS growth and that all-important double-digit free cash flow growth. This is management putting a stake in the ground and making a promise to the market.
It's certainly an optimistic forecast. I'll give them that. My question is simple. How? How do they achieve that level of margin expansion and growth if their entire industry, as we just saw, is in the doghouse? If clients are tightening their belts and competition is fierce across the whole sector, achieving this kind of performance is going to require absolutely flawless execution. That is a very, very heavy lift.
Another key signal from management, and, this is another one of those actions that speaks way louder than words, is their commitment to returning capital directly to the people who own the company, the shareholders. This isn't just some vague promise of future growth. This is cash in your pocket today, and that strategy starts with their dividend policy. They just declared a quarterly cash dividend of nearly 75 cents per share. That's going to be payable in the middle of February. This is a direct cash return to investors. It is a tangible, real reward for holding the stock. And for a company to commit to this kind of cash outlay quarter after quarter, they must have extreme confidence in their ability to generate cash well into the future. And to me, I see this as a clear signal of financial fortitude. A company that's worried about its future hoards cash. It doesn't just hand it out to shareholders. This dividend payment demonstrates a robust balance sheet, and it signals absolute confidence from the board of directors about their future cash flow. It's a reward for shareholder loyalty, period.
I see it as a potential opportunity cost. Look, in 2025, the company spent $1 billion on share buybacks. Now they're layering these dividend payments on top of that. With the stock underperforming the market this badly, you have to ask the question, is this the best use of that capital? Should that money be reinvested back into the business to accelerate growth even faster? Or, if you're determined to return capital, shouldn't every last penny go into more aggressive share buybacks while the price is this low? Is the dividend really doing the heavy lifting that's going to move the stock price higher, or is it just a distraction?
Okay, we've laid it all out on the table. We have examined the internal engine, and we have stress-tested the external frame. We've weighed the bull case directly against the bear case. Now it's time to sift through all the evidence, weigh these opposing forces, and deliver the final iron financial verdict. So this is what it all boils down to. You have to balance these two competing narratives. On one side, you have the steel beams of the bull case, that impressive 10% adjusted EPS growth, a massive $3.2 billion in free cash flow, significant debt reduction, and consistent organic growth that's backed by a really confident outlook. It is an operational powerhouse. But then, on the other side, you have the very real stress fractures of the bear case. That top-line revenue miss, the stock's dismal performance against the market, its location in a weak industry, and those lingering questions around its adjusted accounting. Our verdict is this. AON is a structurally sound company, but it's in a poorly located neighborhood. The fundamentals are undeniably strong. This is a well-built machine that is executing its plan, generating enormous amounts of cash, and strengthening its financial foundation every single quarter. You simply cannot argue with the hard numbers. But the market is currently punishing its entire industry, and AON stock is paying the price for that. The opportunity here is for an investor who is willing to bet that this kind of financial strength will eventually win out over negative market sentiment in the long run. The trap, however, is that this negative sentiment could keep the stock suppressed for the foreseeable future, which would just lead to continued underperformance. So the final question, the one you as an investor have to answer, is this. Do you bet on the quality of the building, or do you stay away because of the neighborhood it's in? That's the decision you have to forge for your portfolio.